Welcome to Save to Invest. Today we're going to look at the important topic of combating inflation. What is inflation? Inflation is the depreciation in the value of money and thus rising prices. In the UK and USA, they use a consumer price index to try to check the prices people pay and compare them with previous periods. Many nations have similar methods. Many people are confused about percentage rates and inflation. Here we're going to try to explain how these work in an easy way. Let's start from very basics. A percentage is a number as a fraction of 100. For example, 4% means 4 out of 100. 50% is 50 out of 100, and so on. So far, we're not talking rocket science. However, when it comes to inflation, it seems people get very confused. This is particularly the case of journalists. The other day I read that inflation rates were falling. This wording tends to mislead people. It gives the impression that things are getting cheaper. In fact, when inflation falls but it is still a positive value, it means that prices are rising but not so fast as before. Let me illustrate this with an example. Let's say that the price of energy rose at 10% per year every decade since 1950 until the year 2000. This means that the price doubled every 7 years. Then, after 2000, the rise was only 7%. This means it is still rising, but now the prices are doubling every 10 years. In other words, the rise is not as fast, but it's still rising. If you were to take your income, spend what you need to live, then invest it with a return of 1% per year, it would mean you would double your money every 70 years. Meanwhile, if over that same period inflation was at 2%, your money is halving in value every 35 years. What do you need to do? You need to find an investment that is paying higher than inflation. Of course, this is easier said than always done. Firstly, one must find an investment that pays well, and secondly, one that isn't too risky. In our first video, A Beginner's Guide to Investing, we set out the kinds of investments that are short and safe, and the longer-term ones that are risky but flexible. Now for a caveat, or a warning, to all those that have been trawling the internet listening to investments gurus. I call this my warning to the wise. Listen up. To make money, you need money. Ideally, you need 100K to get rich. Virtually everyone who is rich inherited wealth. That's the fact. Take Elon Musk. His father owned an emerald mine. Musk came from wealth. Warren Buffett's father was a financier. Many presidents have wealthy fathers. John F. Kennedy's dad was Joseph Kennedy, and he'd made a fortune in 1929 when everyone else in stocks and shares were bankrupted. Richard Branson was born to a barrister whose family were extremely wealthy. The journalist's favorite rags to riches story of Stelios Hadjiyonou is totally wrong. Stelios inherited $30 million from his father. Seth Godin, the author and famous .com billionaire, inherited vast wealth from his father William. He was also educated at Stanford University, the equivalent to Cambridge in the UK. Now we have that problem put to bed. Let's make sure what your goals are here. What you must do is this: work out what your goal in life is when it comes to investment. Make it a SMART goal. It must be specific, measurable, achievable, relevant, and time-bound. If it isn't these things, please stop and try again. How do you know what is possible? That's what we'll cover next. If you are enjoying this content, smash the like button and subscribe. To begin with, our goal needs to be long-term. Long-term is playing the game of grand strategy. As we noted in our other video, it's important when investing for long-term to take risks. Risks allow fund managers, if you use one, to be flexible. If you decided not to use those kinds of investments, then again, tracking what is happening is important. This means to understand how to invest in the long term, we have two main options. We should attempt to do both. The first is to find financial products, or vehicles as they are also known, that are managed by professional fund managers. The second method is to manage your own investments. As a beginner, I would suggest that we focus on the first method. Most people simply don't have the time to keep a track of the markets. In both cases, it is important that we understand our world's economics, markets, trends, and geopolitics. If we don't at least an inkling of what is going on, we cannot really know what to invest our money in for the long term. To some extent, we need to be able to predict the future. In 2024, we are in a period of inflation, with most forecasts suggesting it will fall. Remember, inflation is still inflation. When journalists or reports from banks such as JP Morgan say inflation is falling, they mean its rate is decreasing. This is not saying commodities will get cheaper. Rather, it is saying they'll get more expensive at a slower rate. Inflation has a knock-on effect on the markets because it makes money more expensive to borrow. This is because one way to combat inflation is to hike interest rates. Governments are often unhappy to do this because it makes them unpopular. People start to have to pay higher amounts on existing mortgages. They find goods more expensive as interest rates are essentially like a stealth tax pushing up costs of every product. To understand why interest rates can combat inflation, we need to dig deeper into how money itself works. Money is created by a central bank printing it, even in hard cash and coin, or mostly, as nowadays, in the form of electronic money. How does this happen? It can only happen when other private banks loan money. If more money is lent, more money is required. If less money is lent, less money is required. During COVID-19 in 2020, the UK and USA governments started to effectively provide subsidies, payments to people and businesses because they could not work. This had the same effect as printing money. However, the people receiving the wealth were not productive. Thus, an imbalance between the amount of money and the goods and services value occurred. When this happens, inflation will begin. This was effectively the same problem as Imperial Germany in the First World War, 1914 to 1918. The Germans funded World War I by borrowing, that is effectively printing government money. By 1923, inflation turned into hyperinflation, where it was better to burn money than purchase coal to keep warm. Illegal activities prospered. The solution was not found until 1930s, which eventually led to war. In 2024, the world is effectively at war. It is a kind of phony war like the early stages of the Second World War. The war is between the West and Russia. There's a potential conflict between the West and China. Why? Russia is a problem because of the Russian leadership being a criminal organization. Russia's leaders believe that the fall of the Soviet Union was a shameful experience. Their ideology is to reconstitute their empire by invasion. The war in Ukraine has had a huge impact on inflation, adding fuel to the fire. It has pushed up energy prices as Russia was Europe's source of cheap energy. Putin took a gamble. He thought the West would simply look the other way and Ukraine would fall rapidly. He could then genocide them and steal all their resources. Russian farms are poor compared with Ukrainian ones. They are often polluted and mismanaged. Ukraine is the wheat, corn and sunflower center of European agriculture. It was also many minerals as well as oil, gas and coal. Ukraine was able to fight back and secure most of its territory with Western support. If that support wanes or fails, then Ukraine is going to be in big trouble. Global markets are thus tense, erratic and unpredictable in the face of a potential war breaking out between Russia and NATO. Putin may take a gamble to invade Finland to test to see if NATO have the guts to fight as one. This could happen if politicians such as Donald Trump took power. NATO without the USA is not as a significant adversary as with it. As you can see, to get to this level of global geopolitical understanding, one has to do lots of research and understand history and geography. However, this exercise is well worth it. It is worthwhile because you will now understand the absolute need to find investments that pay higher than inflation and by some margin. The world we are entering is going to be both as dangerous, if not more dangerous, than the Cold War. Its markets are going to be turbulent, perhaps as bad as the 1970s when oil prices wrecked European and American economies, and as worrying at the pre-war period of 1933 to 1939, which came after the markets crashed and a period of deflation occurred. What is deflation, you ask? Deflation is the very opposite of inflation. Everything becomes cheap, people lose their jobs, and the whole economic system starts to break down. Deflation occurs when the value of money effectively rises. Now, too little money is chasing lots of goods and services. Something like the 1929 stock market crash occurred in 2008 to 2009 when oil prices spiked and US companies started laying off people. They could no longer afford the shipping costs from China to the USA. This led to mass unemployment. People couldn't service their debts and lost their jobs. Deflation on this scale happens rarely compared with inflation. The ups and downs of the modern global economies are no different to what they were like in any period of history, except with one difference. We have artificial intelligence running our global markets. Artificial intelligence changes the dynamics of the situation. Humans make different choices to machines. For example, in tests between a fighter pilot versus artificial intelligence, the latter won every time at dogfighting, the practice of aerial combat using guns only. As artificial intelligence develops, it is already running most of the commodity markets with little human interference. This means it fails to see the human-centric problems. Artificial intelligence, though, will develop going forward to change our markets and even working patterns. There are fears over job security. Artificial intelligence will change warfare. It will also alter how and what we learn. Will a super elite require as many humans as possible to maintain their wealth? Another problem is resources. Can the world carry on transitioning away from fossil fuels to more nuclear power and renewable energy? There are many good reasons why this might be impossible. One is cost. Nuclear is very expensive. Another is energy density. You need lots of space for solar and wind power, and hydroelectric is limited by geography. What happens if we run low on cheap copper, cobalt or lithium or any of the rare earth elements that make our technology possible? These are huge, sweeping questions that help to inform the future investor on what to invest in. You can check out our courses on the Future of Energy College if you want to know more about the future of energy. You can now try to learn more yourself about global markets. Do your own research and try to get a grip on what you think will happen. With this knowledge, you can begin the journey of becoming an investor. We hope you have enjoyed this video. Please subscribe and smash the like button. It really does help. Until next time.